Hey everyone, so in this video we're going to be talking about another rate factor on your insurance policy. This one's a big one. We're talking about credit. So credit is one of the big things that not only insurance companies use, but pretty much anybody, anyone out there is using your credit nowadays to determine your rates. I've even seen, utility companies these days are using credit to determine rates and, whether or not you have to put a deposit down and all kinds of things. So companies in general know credit matters. Credit is a huge factor when determining your risk. So the way insurance companies do that. So number one, almost every insurance company that I'm aware of uses soft credit inquiries. So it is not a hard credit inquiry, similar to like when you're applying for a loan or lending or anything like that. So you don't have to worry about it negatively affecting your credit report when companies are looking at your credit. They're simply doing it just to give you the most accurate ratings. I've had many customers ask me, can you give me a quote without running my credit? And technically the answer is yes, but I always say, why would you want me to? Wouldn't you rather have accurate numbers, accurate information versus inaccurate information? Because if I just make up a number, the only way I can do that, if I go in and do a quote for you without running your credit, it's gonna ask me to declare what I think your credit is. And if I don't know that, if I select something that's wrong, your rates are either gonna be way too low or way too high if I'm not right in my guess as to where you are. Now, the other thing to know is that insurance companies, at least for my knowledge, don't see your actual credit score. What happens is companies take a look at all kinds of factors, including credit, and create what's called an insurance score. And that puts you on a scale. Each company is different, each policy is different, so that doesn't really matter, but they're gonna put you on a scale and kind of put you in a grouping or a rate class based off of all of those factors. So if you have really good credit, that just helps you to have a better insurance score. If you have not great credit or lots of claims or whatever, that's gonna cause you to be in a worse insurance score and a higher rate class. So that's really how they look at that. Now, why does that matter? So credit matters a lot when it comes to paying your bills. That's very important. So if you don't pay your bill, if we're let's say we're insuring you, if you're constantly behind in your payments, you may have a claim that we're covering you for and we haven't received payment on the policy. So there's a lot of that goes into it. Not to mention, people who pay their bills typically are more responsible, right? People who pay their bills on a regular basis, they tend to be more responsible drivers. They statistically tend to care for their property, care for their car, care for everything a little better. So credit is a big factor, and honestly, not just in insurance, but everything. So I know you've probably heard it before, but everything you can do to improve your credit, it's going to save you money, not only in your insurance, but in all kinds of ways throughout your life. So I hope this video helps. I hope it kind of puts things into perspective a little more. If you liked the video, please indicate so below. Give us a like. If you think the video could help others, please feel free to share it out there. I'd love to get the word out to as many people as possible. And then finally, if there are any follow-up questions or something I didn't answer, or maybe even a suggestion for another video, please drop something in the comments below. Let me know. I'll answer questions as best as I can. I love doing these for you guys. Thank you, and I hope you all have a wonderful day. Talk to y'all later.